Welcome to our first panel of the day, officially entitled Covered Bonds in 2018, The Bear Awakens. Or as I like to call it, the world is about to change. Are European markets dangerously complacent about how that change is going to affect us, our institutions, our markets? I know it's not in our interests to dwell on it, but there is going to be more volatility and choppy conditions as the ECB finally draws the curtain on its bond purchase programs. Just because we don't want things to change doesn't mean they won't. Financial markets have recently had a poor track record of discounting the things they don't want to happen. Witness the market's widespread dismissal of the UK voting for Brexit or the US voting in Donald Trump. I liken what's happening right now in European capital markets to my 11-year-old son, Oscar, in the week before going back to school after a long, some would say too long, summer holiday. Of course, he knows he's going back to school, but it's at the back of his mind. That's all in the future, and therefore he doesn't have to worry about it. I mean, how bad can it be? Because he's lying in bed till 11 a.m., his mum's cooking his breakfast and sorting out his lunch. There's no homework to do, and instead he's watching The Simpsons or playing on the Xbox. So when the actual return to school came, it was a bit of a shock. Early morning starts, school uniform, making his own breakfast, making sure he was on time for the school bus, paying attention in class, etc., etc. And after the first week back, it was all a bit too much for poor old Oscar. A few tears on a Saturday afternoon, a lot of complaining about how unfair all this hard work was and how he wanted to be back on holiday. Now, for European financial markets, now is the last week of the summer holidays. For a long time, they've had not too much to worry about. They've had it quite easy. It seems to me that many market actors are in denial about just how tough and difficult a return to normal life will be. And after years of regulatory mothering, intervention, distortion, tight regulation, response to crises, markets may even have been left weaker and more vulnerable than before. So, to help prove me wrong, or indeed to perhaps even prove me right, that we are underestimating just how difficult markets will be and that we need to be better prepared, I'm delighted to say we have our experts ready and primed to debate and discuss what the outlook is for the covered bond market. So let's meet them, starting on my right. Luca, why don't you introduce yourself quickly? Everybody knows who you are, but just for the record.
Well, Luca, I have the pleasure to run the ECBC in Brussels, lovely city. I suggest all of you to come often to Brussels during those weeks.
I am Paul Dudouis. I'm running the long-term funding for CFF, Compagnie de Financement Foncier. We are one of the BPCE group.
Antonio Farina, I'm a covered bond analyst at S&P Global Ratings.
I'm Fritz Leutlen, and I run DCM at DZ Bank.
Bernd Volk, covered bond and agency research at Deutsche Bank.
My name is Frank Will. I'm head of global covered bond research at ECBC and also chairman of the EU legislation working group at the ECBC.
And I'm Lucette Verneau, and I'm currently leading all the quantitative investment strategy at Fidelity International.
Thank you. Great. Before we start, we do have an audience question which is available to vote for on the app. If you haven't downloaded it already, please do so. It's quite straightforward. But hopefully my friends in the AV box can bring up the question that we've put to you. So spreads for a 5-year benchmark covered bond from a high-quality core issuer 1 year from now will be. And as you can see, you can vote tighter, roughly the same, 5 to 10 basis points wider, 20 basis points wider, or much wider. Now, they might pop that up during our panel to see how it's going, but at the end I'll try and remember and we'll have a look how we're doing there. But please do vote. Very interesting, I think, there. But let's start, if we can, with the first topic, which is the end of the purchase program and the turn of the rate cycle, and how has the market coped. So I'd like to ask our panel, first of all, At 101 billion euros year to date, covered bond supply is up 25% from 2017, and net issuance has gone from net negative to 38 billion net positive. Yet the covered bond market has coped very well. Why is this?
Well, I think Oscar is quite right, because Oscar can't do anything about school coming. We can't do anything, or very little, about political uncertainty. It's nothing you can hedge for, it's nothing you can really position yourself in. So we have to take this as an externality in the market to a large extent. And that's why we're sort of just rolling with it, as it were. I think the observation is right. You know, it seems somewhat complacent of what's happening in Brexit, what happens in trade wars and things like that. But there is some reasoning for this. Now, the 101 billion that you mentioned is we were expecting less. We thought it's going to be, well, we're going to end the year at around 110. Now we think we're going to end the year at around 120. So we're going to have some 31, 32, something in the 30 billion net new issuance. But it seems that, you know, that doomsaying that we all did about 2 years ago, or 2.5, I don't remember, it feels like forever, when the central bank started buying and we said, no, everybody's going to lose the covered bond franchise because the central bank is sending everybody away. That doesn't seem to be the case. Investors are engaging. The covered bond spreads have gone up by a couple of basis points, and it brings people back to the table. And I think we owe a great deal to the international issuers and to Luca broadening this market, because that means that a lot of investors who may have left stayed and had the capacity to analyze and stayed in that market for the international part of it.
Yeah, but I think, if I can jump on that, I think one of the reasons is still we have the ECB being active in the market and accounting for a big share. And I think it will be interesting to see going forward with the next few years. And I think one of the reasons why the market is still so stable is because they are still there, and everybody expects there will be a slow exit. I think next year we estimate there will be something like 22 billion of covered bond redemption if they're reinvested. So it's a real slow process, and I think therefore it's sensible for a lot of investors to be not too concerned at the moment. I think it will be interesting to see going forward if we get enough new investors on board. And I think what I feel from a research perspective is that a lot of new investors are coming back, sometimes new investors, sometimes insurance companies who in the past said, okay, the yield level is just too low. But there's a general expectation that the yield level will rise, and they focus less on the spreads. They're looking at the yield levels. And I think the covered bonds can be, again, a more attractive product if the overall yield will increase, but that won't be before 2009 or at the end.
That's exactly why I would argue your metaphor, your story is not fully correct, because the ECB is not saying school starts at this date with exactly this. Basically, the ECB said, yeah, the school may start, but if you're still tired, then we start a week later. So everyone knows, and that's why the poll is probably quite right, because everyone knows if the market is reacting in a way the ECB doesn't like it, they do again whatever it takes or whatever they want. And that's why the exit is, they call it conditional, but it's mainly a market steering kind of exit. And that's why I would argue that first the redemptions, everyone knows they are still there, and second, this basically preparedness to intervene again. And this comes on top of, we have more and more interventions everywhere anyway, keeps this, what we call now market, pretty tight. I saw yesterday a discussion about German housing market. So the yield, the house price and rents go up, and now they're discussing about, basically they blame it on the market. But it's not the market who made the prices go up, it's all this money printing who made the prices go up. So now you have more political interventions and a central bank which is prepared to intervene further. And that's why I would argue, combined with the redemptions, that there is spreads are likely to go wider, but there is a limit, and that's why the investors take it into account. that this is all there, this setup.
Luca?
Well, I think that, taking an example of Oscar, following, Fritz was very right. There are things that you can control and things that you cannot control. But I suppose that Oscar has done the homeworks during the holidays, was reading. Well, at least I think the covered bond community tried to do some homeworks and trying to be ready for that moment. We know that everything is changing. And we try to focus our attention to three main things. First of all, securing regulatory protection. So the directive is making sure and making comfortable investors that this is a strategic asset for the union and is an essential part of the banking union project. I think the fact that we had all the authorities coming to the plenary meeting yesterday, it was a sign they care about this market and they want to fix it in the right way. Actually, there is nothing to fix, but they have to improve the capacity of attracting new investors. Then we have done the homeworks in our little ghetto by improving transparency. I think that covered bond label has attracted new investors, have brought the community all on the same page from Singapore to Canada, and we have improved best practices, transparency, and we are actually leading in this sector. And now we are ready for the challenge. Now we are waiting for a new change into the market. And third element, I think that we put some spice to the most traditional and boring market of Europe. We are discussing about energy efficiency. We discuss about a new kind of asset. So investors, they know that this is a lively corner of the market, a bit boring, but is lively and ready to be a solid pillar of whatever will happen. So I think those elements were our homeworks, and we have done this. We are continuing to do this. We are rushing for the directive, but I'm pretty positive. I don't think that the devil is in the details. If you work on a directive, you know that the solution is in the details, and you have to fix the right solution, and we are trying to do this. So I'm bullish, I'm positive.
I guess that another element to consider is that if we observe increased market volatility that now is contained to certain emerging markets like Turkey or Argentina, this is expanding to other markets. This could trigger a flight to quality. So even investors that traditionally wouldn't be attracted to covered bonds at these spreads would consider the asset class when the question is the return on capital instead of return of capital, the return of capital instead of return on capital. So I believe that there are certain layers of protection. ECB stay in the market, certain investors coming back, and potential flight to quality if worse come worse. So I think that's why this level seems reasonable to me.
And Paul, you did the deal last week. Has there been any detectable change in oversubscription ratios, numbers of accounts, that kind of thing?
Yes, definitely. As you already mentioned, in this context, we already work on, the exit of the ECB since, in fact, September 2014. And in terms of policy, of course, we want to keep the historical investor base. So during the last 3 to 4 years, we, through the allocation process, have a specific look to our historical investor base to maintain, of course, these investors on our book. Regarding the last transaction that we did 10 years, 1 billion transaction, in fact, we see more than 90 different investors with roughly 10% of new investors, so newcomers, for example, corporates. And these guys were not active in our transaction, so it's a very positive element for the future. And we see also definitely ECB reducing its order. So definitely we are in this process of the exit of the ECB. And personally, when you compare in terms of figures, the oversubscription in 2012, it was roughly 2 times. Last week it was 1.6, 1.9 times. So we are not so, different from 2012 in terms of figures, in terms of investor coming on the covered bond market. Yes, in 2012 we saw 400 different investors. Now it's more 250 to 300 different investors in this market. So it's slightly less, but definitely we have the capacity to re-engage conversation and discussion to this historical investor base, and to be sure that through the exit of the ECB they will be there. In terms of behavior through the ECB exit, from an issuer point of view, we anticipate that the maturity that we could achieve should be a little bit shorter, of course, more defensive maturity. But you know that in terms of funding for an issuer, we've got different products. We are able to go through covered bonds, of course. We go through securitization. We go through senior unsecured. We go through short-term papers. So we've got this capacity to mitigate our funding program through different products. So definitely we are ready to manage this exit period.
Yes, as an investor, I think I'm pretty confident into the future of covered bond. I mean, obviously the ECB perhaps is going to reduce their purchasing power, but as an investor, I'm called to draw a new solution for my investor pension plan, insurance account on a daily basis, and covered bonds still represent a major part of this kind of solution. Why? Because they're still solid, they're robust. They can have a little bit of a wiggle in the coming month, but you know, overall we know that the rigidity of the framework has proven to be a comforting stage for the spread over time, with or without the ECB. So I think they're still playing a fundamental role, and we can also see them evolving in the new domain where there's a lot of demand, like green energy or sponsoring green project and so on. So it's not a static product which is inclined to die because they've not come to fashion in the coming years. So I've got high confidence, and I think when it comes to financing green project, socially responsible project, or otherwise, I think covered bonds have a massive role to play in terms of how they've been articulated and how the law will not give the freedom to just finance any kind of project. So I think that's, again, quite a zone of comfort for the investors.
Lucette, just sticking with you, just moving it on slightly to, I mean, we've talked about the impact of ECB and everything, but of course there's other things that we need to worry about too. For example, not to worry about, but there are other factors at play, such as the TLTRO refinancing. And what's your expectation on that? Do you think it will lead to much more supply in this market?
Well, it's hard to say. Obviously, I'm coming from an investor point of view, so probably the bank expert or best position to answer this question. But I would encourage, obviously, the bank to, again, use covered bond quite wisely for a part of their financing going forward. And this is how you can cheaply finance a part that is not particularly profitable in your balance sheet, and then have other instrument which most of the time will endorse a much higher funding cost, because obviously of the probability over time of potential failure or capital reduction. But again, that's a balance that the banks have to play on a bank-by-bank basis. Obviously, this strategic positioning in terms of financing is what I think will make the leaders from probably the laggers in the Eurozone, but also worldwide. And the volatility that we've seen recently in some of bank spread is also led quite often by either too old-fashioned kind of financing plan, or banks which have not exploited the full spectrum and therefore are still paying quite a lot for part of the balance sheet that should be financing with quite secure and stable instruments. So I think there's something to be said in terms of embracing the new generation. As I said, part of your balance sheet might be financing green energy project. Why don't label some of the funding green and so on and so forth? So you have to exploit the interest of investors, and on the other hand, they are the one you're borrowing from.
But I think.
Bert, why don't we hear Bert and then Frank?
That's a very good question, because we still have over 200 billion of retained peripheral covered bonds alone. And in the stronger banks, and also those are retained in the core, they're probably refinanced with what is considered by banks more attractive at the moment, so senior preferred, senior non-preferred, whatever they have access to, or partly deposits. But given that the drawings in the TLTRO were highly correlated to the supply of the retained covered bonds in the recent years, so it will be particularly challenging for Italian banks, I would argue, because we still have over 70 billion of retained Italian covered bonds. We have over 20 billion of Portuguese retained covered bonds. And I doubt they can all be recycled in private repos transactions. So I don't know, maybe there is another support or ECB measure upcoming for the Italian banks in this respect.
Another TLTRO perhaps or something?
But there is, in my argument, there's clearly a need for the weaker banks to, because they are unlikely to refinancing all the retained covered bonds with other instruments, and also the covered bond market, where they very likely would have access to, but it would be too expensive for them.
I think it's quite interesting. If you take a look at the overall volume, we're talking about 740 billion of TLTRO redemption coming up in 2020. And I think what we expect is that some of the issuers will try to refinance them beforehand. They don't want to wait when everybody comes to the market in 2020. So I think that's something where I think we saw already in the first early repayment phase, there was 11 billion. We don't expect much in September, or maybe December should open not much, but I think comes 2019, I think we see probably more early repayments. I had discussion with a lot of different issuers, and if you ask some of the Italians, some of the Spanish, they sometimes don't really understand the question, why early repayments are such cheap money, and for us would be far more expensive to come to the market and to finance. So I think most of them, they will probably will hold on until 2020. But some of the French, German, Dutch issuers, they are aware of this problem, and I think they might start refinancing in 2019. That could, of course, have an impact on the covered bond market. But also, what you should not forget, the 740 billion looks like a massive number. But if you go back when the ECB announced the program, there was this massive demand for 4-year assets. So what we have seen, that a lot of banks thought, okay, that's a very interesting no-brainer. You buy assets in the market with, like BTBs, offer you some really attractive yield, and you get cheap funding from the ECB, and you just make this carry trade. So if the redemption comes up for a lot of the Italian issuers, they can also then easily just set that off. I agree, I think of the retained covered bond side, that has to be refinanced properly in the market, but a big chunk of the 740 billion was just a carry trade. So the asset will also then redeem and therefore not trigger some additional funding needs on the banking sector.
What about, sorry, in a minute, Luca, but what about Bernd's point about what about those banks that might struggle? Do you think we'll have a more local form of TLTRO, for example, places like Italy, or?
Yeah, of course. I think like you see some of the particular. The problem is also with the numbers. I mean, everybody says, "Oh, the Spanish and the Italian, they have so much TLTRO money." Yes, I think in terms of published figures, that's a big chunk, but only 50% of the issuers have really disclosed that they will participate. So there's a big chunk of Dutch, French, German issuers who have not properly disclosed how much money they have. So I think that's also something where we have to be a little bit careful, just saying, oh, it's just the Italian, only the Spanish. I think that's something where we have to bear in mind. Nonetheless, I think Bernd is right in terms of taking a look at the retained covered bonds. They have probably to be refinanced in the private sector market, but it's not like the 740 billion, but we have that on face value on that.
Luca, sorry.
Of course, I will not comment on the Italian situation, but I mean, I think that we have to see things. The LTRO and also the intervention of the ECB was an emergency solution. The big part of the story is not actually there in Frankfurt, but I mean, the big part of the story is building the infrastructure of the new financial services in Europe, which is Capital Markets Union, which is Banking Union, and the SRB, and all the system that has been created in Brussels, which is not yet finalized. And the big question mark is that will be this finalized before the end of the mandate of this commission? That's, I think, the risky part of the game. ECB, I think it will be there. As demonstrated, it will continue to defend this. There is a consolidation process in several countries of the banking system. Italy is one of those. There is an IT revolution, and there is a very important revolution in terms of green. And for me, it's a pity that we don't see a green touch in the covered bond directive. For me, as a lobbyist, I see that we have a big push on sustainability on the European agenda. And then when we build one of the pillars of the funding strategy, we have not seen a clear indication of green. So I think that we, as market participants, we should create some pressure on Brussels. That's why I invite you to join us in Brussels, and to help to fix what we think is not right. Because green investors will not come to this market without a clear regulatory indication. It's up to us to change the IT system of the banking to provide transparency to the set. But I mean, no one will be doing this without a clear indication. It's a huge cost. And we know what does it mean managing costs in a consolidation process. What does it mean managing NPLs without a clear indication from regulators? So I think that the European governance has a strong responsibility in giving indication that the European integration should move forward, and we should not stay in this continuous emergency mood, LTRO or covered bond purchasing.
But they can finish legal packages how many they want. If you only need 5 or 10 weaker Italian banks to tap the market with spreads massively below the sovereign at the moment on average for Italian covered bonds, there will be some spread impact. And the question then will be, is it sustainable, or can banks live with this kind of wider spreads, or will there be another support measure needed outside the legal? Because the legal framework can be whatever it is. It's about the funding for the banks.
I see your point. I'm not an analyst, so I will not comment on this, and I don't have the crystal ball. But I mean, for me, we have to step back and think what we are trying to build. Where are the building blocks of what we are creating? And spreads, at the end of the day, is the result of several factors that have to be factored in the equation. And we have the chance now to give a strong signal, and we have to be very clear on our message. We want to have sustainability in our package. For example, the STS. Do we have a funding package complete? Mm-hmm. The STS market is working. I think that we should have a strong covered bond market. We should have a strong STS. I personally believe that we need also something in between, but I mean, we discussed about this quite a lot yesterday. And we have to have a deposit scheme that will protect depositors in place. I mean, so we have to, it's complicated. It's not, I mean, simplicity, I love simplicity, but sometimes putting together 500 million of people is very complicated, and we need to get the strategy right. And we have a responsibility. Because if we want green asset, we have to tell this. And now it's the moment to speak.
I agree. We need green assets. We need to watch out for the Italian banks. I'm sort of course, if their refinancing costs are, for whatever reasons, are going up, sort of like, you know, they're trying to go to the market with OBGs, and that gets progressively more expensive, then, you know, the question is also, are they able to pass on those costs, those increased liability costs on the asset side? And that's really, you know, it's because you have to look at the balance sheet as a whole and not just sort of focus too much on the liability side.
Just moving it on a bit, when will credit risk start to feature in investor thinking? Lucette, let's start with you. And I think your microphone might be working now, so we can all hear you. But, and the question there really is, do investors always assess credit risk every time they buy a covered bond deal?
Yeah, I don't think it's a magic formula anymore, but I definitively think that we have more ways than one, as we once have, to assess the credit risk. Obviously, the information that we're getting from the issuers of this covered bond are plentiful, to the point where I'm now leading a quantitative investment strategy just by experience, because I can no longer process all this information. So I have to help myself as an investor to technology in order to normalize and formalize this information that I'm receiving in terms of the quality of the covered bond program, how it's behaving over time, what does it mean for NPL to increase in some region or some other country. And we also have the other side of the coins, which is liquidity. Can we access the covered bond we want to purchase on a daily basis? Obviously, MiFID has again provided us a lot of extra data which we didn't have in terms of our competitors and other investors' formulas. So I can relate to what Paul was mentioning earlier on. The market is evolving both in terms of asset managers, in terms of who are the market players in covered bond per se. But I think we have mass information. How you choose to exploit it, and therefore how you choose to come to the conclusion that yes or no you want to invest in a certain program has to be processed in my world more systematically, because we have the information which we never had in the past. We have to exploit this information in order to beat our competitors in the race, but also in order to derive more solutions which are more customized to our and clients that they ever were in the past. Basically, it's not enough to say nowadays that perhaps we have economy picking up and perhaps slowing down in the coming quarters, and then we're all going to be victim of spread widening. Obviously, we have more technology to build solution and build portfolio and evolve the portfolio. Even for long-dated clients, like such as pension plan and insurance, we can build more strategy than we had in the past. But I think we've reached the capacity of human to just build this portfolio on a human basis. So we have to help, like any other industry we're seeing around. I think technology and finance has to play a huge role going forward.
That's because what you say is odd. We put together a harmonized transparency template. We strive for a common European regulation directive standards in Europe around the whole product. We hope that this will emanate globally and that the other issuers follow suit. So we should actually see that the analytics of what you're buying should be easier now. But what you're saying is exactly the opposite. It is, we get more information, it's more dispersed, I have to collect it in different places, and so I need a technological backup to do my credit analysis. That doesn't fit together.
But I think when you talk to investors, it's quite interesting. I think one is like the regulatory aspect or internal rules. So most of them, they have to do once a year some kind of credit assessment. So they do that, they analyze the pool and all this. But sometimes I get the feeling they let them do it once a year and then they put it away. And it's not really like based on we have big influence on the investment decision. And I think sometimes what you see is, depending also like if you have a credit investor or if you have like a rates investor. So if a rates investor who buys OATs and bonds and wants to do something crazy, they buy a covered bond. They say, okay, it's a nice pickup and I buy that compared to bonds. So they spend more time analyzing that and assessing the risk. And on the other side, if you have a credit investor who buys sub-debt of the bank or buys senior unsecured, non-preferred, I think they are quite happy to buy the covered bond and they don't spend too much time analyzing the pool and all this because they focus more on the credit, and if they're happy to buy sub-debt of the issuer, they're also happy to just buy the covered bond if the premium is right. So I think there's also like a different attitude depending on the...
But that's in line with basically rating agency methodology. So if I understand correctly, hardly any rating actions in the recent years, or at least most of them were driven by other factors, not the real cover pool credit quality. It's often, now we have this BRD exemption, so the link to the issuer to the bank credit quality is lower than pre this BRD exemption and all these kind of MREL requirements and regulatory changes. But there is still that the pure cover pool credit quality is not, most times, not the main driver of the rating. So that's why I guess it's also rational that you don't track the cover pool every 4 weeks as an investor.
Well, thank goodness, Antonio, you're here.
I guess that, no, I totally agree with you that historically we've seen, well, big movement in credit rating, especially during the debt crisis. There were a number of factors that were moving these ratings, but consideration around sovereign or the issuer credit rating were mainly the driver in our analysis. Now, it's not that we don't consider the credit quality of the pool. Indeed, we do that, but the final covered bond rating is a function of cover pool, issuer credit rating, and sovereign credit rating. And what we have observed historically is that issuers have a strong interest to achieve the maximum credit rating that they can, given the current condition. Therefore, even if there is pressure on the asset side, say Italian bank or Spanish bank in the past, they will try to replace non-performing assets, apart from legal obligation that they have in certain circumstances. But if the current pool size is not sufficient, they will top up the pool size. They will increase the pool size to make sure that they can achieve the best rating. And then, yes, there are certain variables that are not under their control, such as sovereign rating and the cap that it could impose on covered bond rating, the issuer rating. So they will manage what they can, but then rating action could be triggered by rating action on the sovereign. So I believe that what we try to do as a rating agency is to be as transparent as possible and describe how we see the credit quality of the pool, how we see the credit risk related to, say, sovereign, and then investor can make their own decision.
But I think that the point of Lucette is extremely valid. What is our final goal? The final goal is allow more investors to access this market because we want to have more liquidity, more people buying our papers. That's what we want. Asking transparency and putting transparency everywhere is not always a good thing because you have to explain to new investors coming most probably from outside Europe this market. We tried with the covered bond label and the HTT to do this exercise, in the sense that if they want really deep data, Antonio is here and he's doing his job. But if they need to find and understand why an Austrian covered bond is different from a German covered bonds, maybe they can use a platform which is different, the covered bond label, where they get different things. They have an HTT, which is an easy picture of the covered pool, and we are improving. So starting from next year, you will have a graph automatically created from the HTT, so we can compare the cover pool of Paul with the cover pool of HVB, and you can easily see the two graphs immediately. And an investor should have a good feeling of what they are buying. They should also have access not only to the HTT, but the legislation. The covered bond without the legislation is useless. So they should understand what will happen in case of default, and things. And everything should be in English and very easy, accessible in the same point. That's what we have built. It was a Big Mac. You know, if you are hungry, you can go to a very fantastic French restaurant, an Italian restaurant, but if you are really, really starving, McDonald's, you know what you get wherever you are, and you know how to ask Big Mac, even in China. You know, that's the idea, and I think we are improving. The industry is backing this initiative, and we are there. We are creating our passepartout. And I think this is the point. That's why we are fighting, for example, transparency perversion, sorry to say this, but I mean, when they ask details on things which are actually necessary, maybe Andreas Denger in MEAG, but he already has this information, they don't need this information, but you are killing the compliance for a potential new investor. And the more we are, the better we are. So we need to facilitate access to new investors and translate difficult information in an easy language.
I mean, Paul, as a refined Frenchman, would you really eat a Big Mac?
Sorry.
Anyway, but
Not really, but I understand the point, of course, of Luca. Yes, you're right. Transparency is a key word, and as an issuer, we need to provide this information and how to compare an issuer from a French residential mortgage or French local authority business to a German one to a Singaporean one. So definitely there is a room for segmentation, and I think that, as you said, mentioned, investors have the capacity to find where they are looking for in this huge market, but definitely we need to address very detailed information to the investor to give them, of course, the capacity to enter in this long-dated product, cover bond long-dated product. And back to the problem of TLTRO, once again, from a funding team manager, in fact, we don't have such pressure in front of this problem as, once again, we've got many different products to deal with, and more than that, don't forget that before 2014, the cover bond market in US dollars, for example, was more on the short part of the curve. So that means 18 months to 2-3 years. So we will reopen definitely this part of the curve, and we will have the capacity to raise a huge amount of money in the future, that for sure. So there won't be, from my point of view, any specific constraints in the future. And we've got also the political aspect, as Friedrich mentioned, that maybe we will have the capacity to roll this funding, this cheap funding from the ECB. So no real constraint from funding manager.
okay, thank you. We talked about volumes at the beginning of the panel. Do we think the market still has the capacity for increased new issuance volumes?
Yeah.
Yeah?
I think, well, look, we're going to have next year, we're going to have about 2 billion ECB commitment going forward for the redemptions, so a month, right? That should provide support to dealers, to people like me in the industry, to sort of to keep backing covered trades also when there's a, and it's going to be a more volatile year in terms of spreads. We said that at the end of last year as well, and I think it's true. It was a more volatile year, and that trend's going to continue. So to have the ECB system as sort of a backstop to shift some of the bonds that may end up on your books during a primary market phase that's less conducive than anticipated. That's a good backing for the market, and I think investors, we've had an increase in spreads now, 8 basis points. Maybe we see, I don't know. I think the general consensus here in the room was 5 to 10.
Yeah, can we bring that graphic back up again, possibly? Might take a while.
Yeah.
Yeah, there we go. So 5 to 10, there you go.
5 to 10. Yeah. So if we sort of converge around that number, I think that's going to be again enough to re-engage with investors and to bring investors to the table. And yes, 120 billion in new issuance is not, we've had 150, we've had 180 billion in issuance in 14, I think, well, it was 11 and 12, I think. So there's capacity, yeah.
Yeah, but I think also the issuers have to change their behavior. I think the good old days you could rely on the ECB, 50% of the orders if you're a Eurozone issuer. came from the ECB, and now you see it's like slowing down to 40% to 30%. And I think next year we will see far less. And I think what you then, as an issuer, have to really take into account is that you have to focus on the real money investors. So you really have to be a little bit more, in terms of new issue premium, a little bit more gracious and being willing to pay a little bit up. So like in terms of behavior, and we see that already has had changed in 2018 in terms of initial price talk and final spread. I think 2017 it was a big issue with a lot of investors who were really upset about the behavior from sometimes syndicate, but also from the issuer in the end who makes the final decision. And when you attract investors with a high spread level, and then at the end the spread level, the final pricing was so much tighter. And if you take a look at the figures, you can see it has slightly changed. The new issue premiums are going up, at least towards the summer. I think over the last few weeks, the new issue premiums are also like falling again a bit, but comes 2019, we expect that the new issue premiums have to be a little bit higher. You can't rely on the...
I just found funny that he said the good old times was when the ECB took 50%.
From the issuer perspective.
That's the emergency measure, not the good old times. But,
You're right.
and I would also agree with the 2 billion of redemptions supporting, and also higher real redemptions next year than this very low 88 billion. The market can digest more, but the obvious is the more, if there really, we would have 150 billion in issuance, spread will be wider. And yes. I guess in 150 billion, we might have more than 10.
DZ Bank does not officially believe it's going to be 150 billion next year. Yeah, that's
170.
170. That was just a number. That was just for example.
Okay. We need to finish in a minute, but I want to also ask, I think, an important question, which is, following the Banco Popular episode, is the Resolution Authority more likely to take preemptive action again, in particular against Italian banks?
Okay, I think it's quite interesting. I think one thing, and I was before a bank analyst, before I became a covered bond analyst. I think in the past, and coming back to the good old days, I think it was like a situation when one of the banks got into trouble, the entire country, the banks in this country suffered. And I think what we see now, that the new measures are working, and if there's some kind of issue, then only those banks who are really affected widen, and the rest of the market is relatively stable. So that is quite good. So the linkage to other banks in the country is limited. However, at the end of the day, and we saw that in Italy and also like in Spain, it's a political decision. I think the reason why other banks buy a bank for €1 is not just by chance that they calculated the assets, what's the value of the assets, and suddenly you end up with, it's exactly €1, and suddenly you can buy for €1. I think that is, of course, a political decision. And you can see, although these rules are in place, some of the regulators or also the politicians, they're bending the rules a bit. But I think in general, what they really have broke up, and that's really a good thing, that's no longer affecting, I think, all the banks in one country if someone gets into trouble.
Well, I have to say, considering that half of my staff went to work for the SRB, I think that now it's fully operational. I mean, the institution has been created a few years ago, and it's ready to take action. I think it's important for the market to know that they are there and they are ready to take action. They are fully operational. This is already keeping some kind of balance. But then I fully agree with Frank. I mean, we have seen the case of Banco Popular, but we have seen other cases of other countries more right, that a political importance has created a different situation. So, I mean, Europe is trying to intervene, but there is also a national aspect that has to be considered.
I'm not a bank analyst as well, but I believe that there can be something that the government is proposing, but then you need to find an agreement with the European authorities. So you need to understand also the goodwill that you will have towards this authority. So it's difficult to predict, but if they try to save some weaker lender, for example, in Italy in the future, then there will be an intense discussion going on, I guess.
Okay. Okay, well, I think we're almost out of time. I'd like to have one quick final look at that graphic if possible. Just, I'm sure it hasn't changed much since we last saw it, but there we go. So I think that's fairly emphatic, isn't it? That we think that 5 to 10 basis points wider this time next year. Given what I said about my son going back to school and not really liking it, you won't be surprised that I voted for 20 basis points wider. But any questions from the audience, ladies and gentlemen? Do you have any questions that you could pose to our panelists here? We probably have time for one very quick question, if anyone has one. Can't see anyone with their hands up. So I'm going to ask one final question of our panelists so that we end on a question. Under what circumstances is senior preferred debt better than covered bonds?
It's two different tools, definitely, and you are not targeting, of course, the same investor base, and in some extent, and it's the case this year, you are obliged to use the two different products, and you have to, once again, to mitigate the two different products in terms of cost. You know, senior non-preferred costs much more than the cover bond, so you need to be on the two products. And in terms, of course, of maturity, you are not targeting the same maturity. You know that cover bonds and in this volatile environment that we anticipate for 2019, definitely investor will have a look to this robust, long-dated products through cover bonds, and senior non-preferred is another product for another use for funding, definitely. So it's a complementary policy that we have using these two tools. Yeah.
I think it's a question of price, and it really depends. You can't say this is better. It's like at the end of the day, everything has a price, and if you have a AA rated issuer, issued senior preferred, has a big chunk of senior non-preferred protecting that, fine, and the gap to cover bonds, it's wide, I buy it. If it's like a weak issuer, which has not much senior non-preferred issued, so the protection you get from this additional cushion, and it's weak, and there's also risk that you could be bailed in. I would only buy it if there's a really big spread to cover bonds. So it really depends on the issuer. It depends also not only on the rating, but also in terms of how much additional cushion you have from the below.
But very quickly.
Senior preferred sounds basically better than junior covered or ordinary covered.
Yes.
But I would also agree that it depends on the circumstance. If you have the German found a very elegant model with transferring all the seniors to non-preferred, the outstanding.
Not every investor was happy about that.
Of course, but it gives them a lot of cushion for the new issues. So if you have only a few senior preferreds now outstanding and all the non-preferred buffer already, it's quite a big buffer there which is available.
I guess in the German context, when you have a good, well-rated bank and you have a spread of 30 basis points or over, that then senior preferred looks attractive.
I'm sorry, sometimes you also get the protection schemes, which is also covering the senior preferred, so from two banking groups in Germany.
Well, thank you. Thank you very much.